Welcome back to the deep dive. Today we're ripping the lid off the latest numbers from Visa.
Yeah, the global payments giant, they just released their fiscal fourth quarter and full year 2025 results.
Yeah.
Hot off the press, basically.
And looking at them, there's this confusing picture right at the top, a real paradox.
Absolutely. I mean, operationally, things look great on the surface. Q4 net revenue hit $10.7 billion. That's up 12% year over year. Very solid.
Right, solid growth. But then you see the GAAP net income.
Exactly, that was down 4%. And the GAAP earnings per share, the EPS, it actually dipped 1%.
So wait, more business, more revenue, less profit. How does that work?
It's definitely the kind of thing that makes you scratch your head. Financial whiplash, you could call it.
So our mission today for you listening is to give you the shortcut. We want to cut through all that accounting jargon, the GAAP versus non-GAAP stuff, and, figure out what's really going on.
To understand the true health, the real momentum behind Visa's engine, because there's definitely some noise obscuring the view this quarter.
A lot of noise, it sounds like.
Yeah, quite a bit. And as you suspected, that gap between the strong revenue and the weaker GAAP earnings, it pretty much comes down to one massive item.
Okay.
It's an operating expense, but not really an operational one, if that makes sense. It's the litigation provision.
Ah, the lawyers again. So not inefficiency, but legal costs dragging down the profits. How big are we talking for Q4?
Big enough to really make a dent. I mean, GAAP operating expenses overall jumped 40%.
40.
But the main driver, an $899 million provision just for legal stuff.
$899 million. Wow.
Yeah. And it's mostly tied to that huge, long-running interchange, multi-district litigation, the MDL, about retailer fees, plus some other legal bits and pieces.
So nearly $1 billion earmarked in just 3 months for liabilities that, well, they don't really reflect how the network performed day to day, right?
Exactly. It's like a big necessary financial cleanup, but it's separate from the core transaction processing business.
And that was just Q4. What about the whole year?
The full fiscal year 2025 picture is even starker. Visa set aside a whopping $2.562 billion just for these litigation provisions.
$2.5 billion. Okay, so if you want to see how the actual business is doing, you really have to look past that number.
You absolutely do. And that's where, the non-GAAP metrics become so crucial.
Right, the adjusted number. So analysts basically strip out these big kind of one-off costs, the legal charge, maybe severance, amortization.
Precisely. Things that aren't part of the regular operating rhythm. And when you do that,
The picture changes.
it completely flips the narrative.
Yeah.
Seriously, look at the non-GAAP EPS for Q4. It was $2.98. That's up 10% year over year.
Okay, up 10%. That sounds more like it given the revenue growth.
And for the full fiscal year, non-GAAP EPS climbed 14% to $11.47. Strong double-digit growth.
So that proves it then. The underlying business model isn't just healthy, it's actually accelerating. The GAAP drop was more like very expensive legal housekeeping.
That's a good way to put it. Necessary,
Yeah.
but masks the core strength.
All right, so let's move past that balance sheet noise then. Let's look at the engine room itself, the actual activity. What are the operational metrics telling us?
Yeah, the core performance is really solid, especially when you look at constant dollars to take currency swings out of the equation.
Okay.
Processed transactions, just the sheer number of times people used a Visa card that was up 10% in Q4.
10% growth in taps and swipes. How many transactions is that?
67.7 billion in the quarter. And for the full year, get this, 257.5 billion transactions processed across the network.
Incredible scale, just massive. Okay, so transactions up 10%. What about the actual money spent, the payments volume?
That grew too, just slightly less dramatically. Payments volume was up 9% in Q4 and 8% for the full year. Still very healthy growth.
And where's the most, let's say, lucrative growth coming from? I always hear about cross-border.
You heard right. Cross-border volume is key because Visa generally earns higher fees when money moves between countries. It's a great indicator for international travel and global e-commerce.
So are people packing their bags and shopping internationally?
The numbers strongly suggest they are. Total cross-border volume in constant dollars grew 12% in Q4.
12%. Nice.
And there's a metric analysts often watch closely. Cross-border volume, excluding intra-Europe. Think of it as a sort of pure signal of long-haul travel and non-EU trade.
Right, taking out the closer EU to EU stuff. How did that look?
Still very strong. That grew 11% in Q4 and actually 13% for the full fiscal year.
13% for the year. Okay, so that sustained double-digit growth really points to a robust recovery in international activity. Travel, commerce, all of it.
Seems that way, yes. The The momentum there is clear.
And it's not just usage, right? They're putting more plastic or, digital equivalents out there too. Card growth.
Absolutely. Total Visa cards in circulation hit 4.9 billion globally.
Almost 5 billion cards.
Yep, that's up 6% year over year. And interestingly, credit cards actually grew a bit faster than debit.
Oh, how much faster?
Credit cards were up 9%, hitting 1.5 billion. Debit cards grew 5%, reaching 3.4 billion. So still more debit overall, but credit is picking up pace.
Interesting. Maybe show some consumer confidence or perhaps strategy from the banks pushing credit?
Could be a mix of both. Definitely something to watch.
Okay, let's connect this back to revenue. Transactions up 10%. Where did that show up most clearly in the Q4 revenue streams on a nominal basis?
Well, the fastest horse in that race was data processing revenue. That jumped 17% to $5.4 billion.
Makes sense. More transactions, more processing fees. Almost a direct link.
Pretty much. Then you had international transaction revenue and service revenue, both growing a solid 10%. So fairly balanced growth across the main fee types. Oh, and other revenue was actually up 21%, hitting $1.2 billion.
Okay, strong growth pretty much everywhere. But there's always a but, isn't there? What about the money Visa pays back to banks and partners? Client incentives.
Yes, client incentives, that's the other side of the coin. And you're right to flag it, they rose significantly.
How much?
Up 17% in Q4 to $4.2 billion.
17%. Wait, that's growing much faster than the payments volume, which was up 9%.
Exactly. That's a really key observation. It suggests that, well, maybe the competition is heating up.
Meaning they have to pay more to keep the banks issuing Visa cards and routing transactions their way?
It looks that way. They're successfully driving volume, no doubt. But it seems they're having to offer bigger incentives, bigger rebates, essentially, to secure that market share. It's effective, clearly, but it makes the volume a bit more expensive to acquire.
Right, eats into the margins somewhere. Okay, so that puts pressure on expenses even before we count the huge litigation charge. What about the regular operating costs? If we look at the non-GAAP expenses, stripping out the litigation, they still went up.
They did. Non-GAAP operating expenses rose 13%.
And where did that money go? What were they investing in?
According to them, it was mainly driven by increases in personnel, general and administrative costs, and professional fees.
So people, overhead, consultants.
Basically, yeah. It points towards ongoing investment in the business itself. Things like technology, maybe building out their Visa as a service offerings, just general infrastructure to handle growth and, fight off the competition.
So even without the massive legal hit, the cost of running the business and investing for the future is definitely climbing.
It is. They're spending heavily on defense, legally speaking, and on offense, operationally speaking.
Which I guess brings us to their cash situation. They must be generating a ton of it. What did they do with all that free cash flow in Q4?
They certainly generated a lot.
Yeah.
And returning it to shareholders was clearly a top priority.
How much went back?
A huge $6.1 billion just in Q4.
Wow. Mostly buybacks?
Yep, $4.9 billion in share repurchases. And another $1.1 billion paid out in dividends.
And they feel confident enough to raise the dividend, too.
They do. The board boosted the quarterly cash dividend by 14%, up to 670 cents per share. That's a pretty strong signal of confidence in the future.
Not surprising when you see the cash flow numbers. How much free cash flow did they actually generate in Q4?
$5.849 billion. Just in the quarter.
An absolute cash factory, and they still had plenty left over.
Oh, yeah. They ended the fiscal year sitting on $20 billion in cash, cash equivalents, and investment securities. A very comfortable position.
That kind of cash pile lets them do some interesting things strategically. You mentioned the litigation stuff earlier.
Yeah.
There was another move related to that, right? An escrow deposit.
Yes, exactly. Another one of those technical but strategically quite clever maneuvers. On September 25th, they deposited $500 million into a specific U.S. litigation escrow account.
Okay. $500 million set aside for legal fights. What's the purpose?
It's part of their U.S. retrospective responsibility plan. Basically, the whole point of this escrow is to shield the Class A common stockholders, that's regular investors like you buying shares on the market, from financial hits related to certain old ongoing legal cases.
So it's a defensive move to protect shareholders.
It is. But here's the really interesting part, the financial engineering nugget, as you called it earlier.
Go on. How does putting money aside for lawyers actually help earnings per share? Seems counterintuitive.
It does, right. But it's about the structure. When they put that $500 million into the escrow, it actually reduces the share count of Visa's other classes of stock, the Class B1 and B2 shares.
The ones created just to handle legal liabilities.
Exactly those. And Reducing those share counts, economically, has the exact same positive effect on the overall earnings per share calculation as if they had just gone out and bought back $500 million worth of the regular Class A stock.
That's clever. Turning a legal defense cost into something that boosts EPS, just like a share buyback.
It really is quite ingenious. It's a way to manage risk and enhance reported shareholder value simultaneously.
Yeah.
Classic Visa, in a way.
A great example of why you need to understand the mechanics behind the numbers. What was the other technical cleanup item they mentioned? Something about Visa Europe.
Right, that was the final step, or rather the fourth release assessment, related to their big acquisition of Visa Europe back in 2016. So on the ninth anniversary, which was around August 2025, about $1.4 billion in value tied up in specific series. B&C preferred stock was released. It's just part of the long-term plan for financially integrating that acquisition, basically ticking off another box in a complex historical cleanup.
Got it. So tidying up the books, managing litigation creatively. Let's wrap up with the future then. After wading through all this, what's the outlook? What does management expect for fiscal year 2026?
They sound pretty confident, actually. The forecast is for continued strong growth.
Specific.
They're guiding for low double-digit growth across the board, net revenue, operating expense, and diluted EPS for the full fiscal year 2026.
And that's on the adjusted basis.
Yes, crucially, that's on the non-GAAP adjusted constant-dollar basis, so stripping out currency effects and those big non-recurring items like the litigation provisions we discussed.
So the core message is, expect the operational engine to keep firing, growing revenues and profits at a healthy clip, even with ongoing investments.
That seems to be the expectation, yes. Continued growth and market share gains.
Okay, so the big takeaway for you listening is pretty clear. Don't get spooked by those headline GAAP numbers. They were seriously skewed this time by those unique legal provisions.
Right. The core business itself, measured by transactions, cross-border activity, and those clean non-GAAP earnings, looks really robust.
The challenges are definitely there managing competition, as shown by those rising client incentives, and obviously funding these huge ongoing legal battles.
But the underlying strength is hard to deny. It's still a powerful growth story, even with the significant costs of operating globally in such a complex regulatory world.
Which leads us nicely to our final thought for you to mull over. We saw just how much money, over $2.5 billion in fiscal 2025 alone, is being channeled into these legal provisions and escrow accounts. It's all about managing these long-running disputes.
A huge chunk of change.
So here's the question. What if those major legal overhangs, those big regulatory fights, were somehow fully and finally resolved in let's say, the next few years? How would that fundamentally change Visa's capital allocation strategy?
Interesting question.
Would all that money currently earmarked for legal defense just flood back to shareholders through even bigger dividends and buybacks? Or could it unlock a whole new level of investment in, say, R&D, acquisitions, or maybe even faster infrastructure build-out? Where that capital gets pointed next could really define the next chapter for Visa.
Yeah, how they'd redeploy potentially billions.
Yeah.
It's definitely something worth keeping an eye on. It's a fascinating potential shift.
Indeed. Something to think about. That's all we have time for on this deep dive. Thanks for joining us.